Let's check the tech sector right now. Our next guest says that from the Magnificent Seven, six are still magnificent. Joining us now, Doug Clinton, Deepwater Asset Management managing partner and co-founder. Doug, can we assume, is Tesla the one that got booted out?
It is. I mean, just, Mike, when you think the news couldn't get any worse for Tesla, we have EV demand questions that have been popping up over the last few quarters. We have questions now about whether they're going to build the low-cost Model 2, price cuts on FSD. I think that investors are still questioning now, is Tesla still one of the Magnificent Seven? For us, I think it's clear there's six that are incredible companies. I think Tesla is still a really great company, but it's the one now that has the most to prove.
The six that do remain, for the most part, are being animated, maybe with the exclusion of Amazon and Apple, by the AI excitement. Is that correct? Obviously, there's been some break in momentum in things like Apple, but what would you right now at today's prices prefer to emphasize in terms of these names?
I think one thing that struck me this weekend, we think about the global conflict that we're dealing with, something we were saying last October when we were concerned more in the markets about rising rates is all these names, all six names, are in a way both offensive and defensive. And that's the thing that we think a lot about when we try to position our portfolios with the Mag 6. I think these stocks are offensive because, to your point, most of them do have AI exposure. They all have pretty great growth profiles, but they're also defensive because they have fortress balance sheets and because they generally sell products that I think would be well positioned to weather any sort of economic issues. So I think that's the way that we should be thinking about these stocks. They aren't trading at egregious multiples, despite what I think some other investors might think, given the moves they've had. The group trades about 30 times forward earnings. The peak over the last 10 years, 38. The trough is 20. Are they cheap? No, but are they egregiously expensive? I don't think they are that either.
Yeah, well, and just quickly, Netflix is a fraction of the size of those six, but obviously it's been a great stock, and they are going to be reporting, and does have, 30 plus PE as well. So how do you think that one is set up?
I think it's set up where the bar is actually pretty high. You think about the story for them over the last year. The question has been, are they kind of at the end of their growth phase? They're moving into ad-supported models. They're looking to crack down on password sharing. We've seen that now for a year. They had an incredible Q4, 13 million net sub ads. I don't think investors thought we'd see numbers like that anymore from Netflix. And now I think the bar is a little bit high. We got to see really good net sub ad numbers for Q1. The bogey's about 5 million. And I think we want to see strong guidance for Q2 as well. So that bar is high for them.